Afternoon, everyone, and thank you so much for joining us on this Tuesday evening and or morning, depending where you are in the world. So I'm Michael, and I'm the Secretary of the South African Chamber of Commerce here in Singapore. Over the last 4 years, we've been building a community for business people to get to know each other and get opportunities to work together, as well as share knowledge and experience of our and expertise of our members. So yeah, today is a little bit more of a knowledge sharing session, and we're going to be really just focusing onto South African pensions from a expat perspective. So people living and working overseas, what does that look like? What are your options? What are your choices with your pension? What are the considerations you should be making? And how do you make those? So essentially, what we're going to cover off is an overview of South African pensions, how they work, how you can withdraw from them, how you can transfer and consolidate them, and all of that sort of thing. So we are joined here today by our expert member, Marisca de Bruyn, from Mint Accounting down in Cape Town. And Marisca is an international tax advisor and a specialist in non-resident taxes for South Africans. She has helped a lot of my clients here in Singapore to understand and navigate the realms of being a non-resident South African taxpayer and what that means. So Marisca, do you want to introduce yourself and Mint Accounting and how you guys help your clients?
Yes, thank you, Michael. It's always nice to meet with you in this way. And I'm Marisca, as Michael said, and at Mint, we do tax migration services. So we assist people to seize their tax residency, as well as facilitate the entire process of withdrawing their retirement annuity funds if they've obviously been out of the country for 3 years. So basically what people would refer to this as the full tax migration process. So we do that. And then we also assist clients with normal individual taxes, and especially clients who have emigrated to do their expat tax, because sometimes that can be very complicated. And also I provide tax advice on complicated structures and just especially international tax laws of where you need help to understand who has the right to tax you between South Africa and the country of residence.
Very important to understand who has the right to tax you, because some regimes have lesser tax than what South Africa does. So a little bit further about who I am. I'm an associate partner of St. James's Place, and essentially I'm a certified financial planner, so CFP, and I focus on helping South Africans abroad to understand their options with financial planning, from retirement planning to estate planning, succession planning, multi-jurisdictional asset structuring, and how to get the best out of your portfolios while mitigating taxes, depending on where you want to end up next, be it South Africa or Europe, UK, Australia. We have the knowledge and expertise between myself and Marisca to basically help you figure out what is the best route for you to pursue. So without further ado, let's dive into our workshop. So as it says on the screen, and I hope you guys can all see that, the South African pension workshop is what we're going to be discussing here today. And essentially, we've already done our little introduction, so I'll just skip this part, but yeah, those are pretty pictures. So pensions in South Africa, and being South African, of course, it's complicated, it's not simple. There are a multitude of different products available, and each of them have different mechanisms, and they work in a different way. So essentially, we have retirement annuities, pension funds, provident funds, and preservation funds. So if you've ever worked in South Africa and you worked for a company that offered you pension benefits, most likely you received a contribution to a provident fund. So a provident fund is generally a fund where there's a relationship between an employer and an employee. A retirement annuity is much more of a personal product that you would probably take out from a financial advisor or a broker in South Africa. And essentially what the retirement annuity aims to do is just to help you save towards your future to pay you an annuitized income when you do come to retire. A pension fund is something that is more utilized for you to saving capital, so investing capital and building up capital. And then basically it will also at age of retirement convert into a annuity for you. And then a preservation fund basically preserves the three that we've just discussed. So if you were to leave a retirement fund, you can transfer your benefit to a preservation fund, a retirement annuity preservation fund. If you have left your company and you have a company pension, you have to then transfer that away from the company pension. You can transfer it to a provident preservation fund. So the preservation fund is really there to do, as it says, to preserve your fund. So I guess what happens when you've lived abroad and you've worked a couple different jobs, you probably have a retirement annuity and a provident fund and maybe a preservation fund from a previous employment. And what happens then is that it might make sense for you to consolidate and to start bringing assets together. Unfortunately, you can't transfer a retirement annuity to a pension fund, and you can't transfer a pension fund to a provident fund. So essentially what would happen is if you want to transfer a provident fund, you would have to withdraw it and likely pay withdrawal tax on that, and then reinvest it into a pension fund or a retirement annuity, or you can transfer it to a different sort of fund, such as a provident preservation fund or a pension preservation fund or a retirement annuity preservation fund. But basically there's something called a Section 14 transfer, and all that means is you can only transfer a recognized fund to another recognized fund, a retirement annuity to retirement annuity, pension fund to pension fund, etc. So I guess, Marisca, over to you. I'd like to ask you now, when it comes to retirement pots and when it comes to withdrawing and actually getting your money out of these funds, how and when does that happen, and what taxes are payable for doing so?
Okay, so I'm going to start with the retirement annuity, and the retirement annuity is the most blocked fund, I would call it that, is that the only time you can withdraw from your retirement annuity is at retirement age. So mostly that's at the age of 55, but funds obviously have their own rules as well. And at that stage with the retirement annuity, you can withdraw 1/3 lump sum, and then the 2/3 lump sums that's remaining, you need to use to purchase a living annuity with, which obviously will pay out however you choose. And if the value of that is below 247,500 Rand, you can still withdraw your full lump sum. So that's the retirement annuity. If you have emigrated and you've ceased your tax residency and you've now become a non-resident for 3 consecutive years, then you can withdraw your full retirement annuity as a lump sum, and it would be at a higher tax rate because it's taxed at the retirement withdrawal lump sum, withdrawal tax benefits tables. So that's retirement annuity. Then your pension fund, you can withdraw when you resign from your employer. So that's an easy one. The Provident Fund is a bit more complicated because of the annuitization that happened in March 2021, which I believe we'll discuss in a bit more detail later on. And then your Preservation Fund, you could withdraw from a lump sum. Once in your lifetime, you get the opportunity to withdraw a lump sum from that fund. Once you've done that lump sum withdrawal and there's still a balance in your Preservation Fund, then it would have the same rules as the Retirement Annuity Fund, where it has to be in the fund until the age of 55 or whenever retirement age is, and then only 1/3 lump sum can be withdrawn, or 2/3 lump sums needs to go into a living annuity.
Yeah, I mean, another thing that most people don't realize when it comes to withdrawal is that if you do a withdrawal before retirement age of a retirement annuity, a provident fund, and a preservation fund, let's say, at different stages. So in 2016, you withdrew from a retirement annuity fund, and it was under the withdrawal table threshold. So perhaps you didn't pay tax on it, or a very small amount of tax. then when you come to withdraw 5 years later from a provident fund, for example, you're not going to be taxed just on the amount being withdrawn at that time. They will look at your previous withdrawals and how much tax was that paid at that time. And basically they accumulate your withdrawals over the periods to decide how much tax would be payable on those. So it can, it's not an easy decision to go, I'm going to withdraw from my retirement annuity, because it can have long-lasting impacts to your future withdrawals and how those could look. So that's something else to just bear in mind. So that's kind of an overview of the types of pensions that we have and how they work, when you can withdraw from them, and the taxes, etc. So moving on to the next piece. This is now getting into how your money is invested. So we've covered off the products, and essentially we've covered off the taxes and how you can access your funds within the products. But ultimately, these are investments, and what you're trying to do is to grow your capital for your retirement, so you can actually retire one day. Now, because this is a pension product, it needs to be a safe product. So there's something called Regulation 28, which is essentially a regulation which governs where your money can be allocated for your investments. And what you can see is only 45% of your retirement annuity or pension or provident fund can be invested overseas, say in the US stock market or the UK stock market, or other growth engines such as the Asia Pacific stock market. The rest of it has to be invested domestically, and you can only invest up to 75% in equity or stocks. So again, yes, this is your money that you're saving towards the future, but it comes with restrictions from a product point of view of when can you access it and how is this money taxed. And when it comes to withdrawing and living off the income of your hard-earned, saved retirement money, the product governs how you will do that. Now, in terms of your actual return on investment for doing this, again, it is limited and governed by law, and this limits how you can grow your capital in the long term. If retirement is 25 years from now, or 20 years from now, or 15 years from now, or even 10 years from now, you should probably be able to invest 100% of your money in equity, because over the longer term, yes, it's volatile, but this is money for the future. And that would yield the best possible growth for you. And essentially, Regulation 28 is there to protect pensioners. But at the same time, it's when you're investing in rands and you don't have exposure to overseas stock markets at over 45% allocation or more, you could be limiting yourself to growth of 8 to 10% a year, maybe over an annualized period, over a long period of time in rands. And with inflation at kind of 6.7 to 7% in South Africa, your net return is 3% or less than in real terms. So this is where it becomes important into how you allocate your pension. And while you're living overseas, really doing a review of how these assets are invested to maximize them and make sure you do get a decent return on them. Now, something that Marisca touched on earlier was kind of provident funds and what has changed. Essentially, provident funds of the three were the most unrestricted. So of a pension fund, a retirement annuity, and a provident fund had the least restrictions when it came to access. You were able to access all your benefits one time before you turned 55, and basically you could have saved up your life savings and got full access to it before 55. Yes, it would have been taxed, but you had that access. What has happened from the 1st of March 2021 is this has changed, and they've basically introduced something called a two-part system, where you have your vested rights, so your rights to your pension that is yours, and your unvested rights, which now have annuitization rules applied to it. So I know that does sound all quite confusing, but before I pass it over to Marisca to explain a little bit more, I'd also just like to touch on the timeline that we have been on, since Marisca and I have been working together since 2020, we've been seeing, the changes to the South African tax regime, as well as the changes to the retirement products landscape, as well as the transferring of capital overseas. So from 1 March 2020, that's when essentially they introduced the cap to income earning of 1.25 million rand for people who are working overseas or who are South African tax residents on their foreign sourced employment income. So essentially, this never used to be taxable before, but if you earn more than 1.25 million rand and you're a South African tax resident, then from 1 March 2020, that income became taxable. The following year, March 21, they introduced this kind of two pots policy that we'll be discussing. 1st of March 2022, there were other changes to pension funds and ceasing your tax residence and when you're able to actually access your funds, and also the changes to Regulation 28 came in. And there's even more changes to come in 2025. And essentially, if you are living overseas, the regime is getting tougher and tougher on not only income tax, but also on how your rights to accessing your life savings and your pensions. And then, as of April this year, how do you transfer that money overseas has also changed. So staying abreast of these things, it is important to kind of join talks like this and have an open line of communication with your financial planner and your tax advisor, whoever they may be, or just seek professional advice in this space, because generally most people are too busy to be able to keep up with every change in every budget speech. Unlike Marisca and I, this is our job, so we do it all the time. So yeah, anyway, over to you, Marisca. Can you explain a little bit about the kind of 1 March 2021 and the two pots kind of rule that they've implemented for provident funds?
Yes, so from the 1st of March 2021, or on that date, what the reason behind it was is just to bring provident funds more in line with retirement annuities. So if you were over the age of 55 at the 1st of March 2021, then you are not subject to these changes. The provident fund would have exactly the same rules that it previously had, which is that you can withdraw it in full, a full cash lump sum. Then if you were under the age of 55 at that date, then you would have a two-part system. So your first part would be your vested rights that you have, and vested rights are always protected. So whatever the fund rules were at that date would have to remain in force. So the value that was in your provident fund at the 28th of Feb 2021 would go into a vested investment, and the same rules apply. Then any contributions and growth as of the 1st of March 2021 would go into your second part, which is the non-vested part, and that would have the same rules as your retirement annuity fund going forward. So that could be withdrawn then at the age of 55 or retirement age, where you can only withdraw 1/3 lump sum, and the balance would have to be used to purchase a living annuity. So if the total value of that pot is below 247,500 Rand, then you can still withdraw a full lump sum from that provident fund. But if the value is above that, then the 1/3 and 2/3 rules will apply to the vested pot.
So essentially what they called this was the harmonization of retirement products in South Africa. That is the reason or the rationale that they've provided for these changes. And the reason it's called two pots is, envision your provident fund, and now there within your provident fund you have all the money that you've accumulated before 1 March 2021 being allocated to one pot, being your vested rights. You have the right to this money in the same fashion that the provident fund originally gave you. Going forward from 1 March 2021 onwards, there's now a second pot for any additional contributions or any growth thereafter going forward. And those are going to be treated exactly the same as, like Marisca says, as your retirement annuity or your pension. So that's the idea of two pots, is you have the money that's already vested to you before this date, and the second part is the money that is growth or contributions after this date. So again, becoming slightly more restrictive as to how you can access your retirement products. So that brings us along nicely to our next piece. So let's say that you are living overseas, you've been outside of South Africa for a number of years, but you also worked there for a number of years. So you've built up your life savings into a couple pensions and retirement products in South Africa, but now you're living overseas. How realistic is it that you can withdraw a retirement income from these products while you're living overseas? How does that work? What does it look like? Essentially, these products are non-discretionary products. So essentially, you don't have the discretion of how you want to utilize the capital. It is basically not retiring on your terms. It's on the terms of the product, where you can only take 1/3 of your money out, and the remaining 2/3 has to purchase a compulsory annuity. And the word compulsory is important because you don't have a choice. So after the age of 55, you can take 1/3 of your money, and 2/3 must be used to produce you with an income. Now, the restrictions don't stop there, because when it comes to how much income you can draw from these products, that 2/3 compulsory annuity, the amount of income you can draw from it is capped at a minimum of 2.5% to 17.5% per annum in income. So if you had 10 million Rand, you can only take 2.5% of that at a minimum, or 17.5% of that as a maximum. And given the raging cost of living crisis that we're in, are those caps enough? Another thing is, generally, you are at the beginning of a policy year or a annuity year. That's when you decide how much income you're going to draw for that year. And during the course of that year, you can't actually make changes to that, regardless of how your circumstances have changed. And basically, if you want to, you have to then write to the pension provider and, in a way, beg for your money, which again is not cool, because again, it's your money. Now, that's essentially in terms of access and how you would draw your income. But guess what? It's not tax-free. That income is taxable. So Marisca, how is retirement income from pensions and provident funds, retirement annuities, how is that taxed in South Africa in retirement?
So Michael, because it's a South African source income, it will be taxable in South Africa. So the fund would need to withhold the pay as you earn from your payout. So obviously you decide you want it monthly, quarterly, every 6 months. But before they receive that payment, the fund will have to withhold the pay as you earn. They're obligated in terms of SARS to withhold that. Then they live in another country, so they're tax residents in another country, and that country also wants to tax this income. And we've got different clauses in the different double tax agreements with countries, and each one kind of has its own rules, but there's a majority of it has the same rules. So it would always read something like, the country of residence would have the first right to tax your pension, living annuity, retirement income, but the country of source also has the right. Or it could read that the country of residence has the sole right to tax it, or it could read that the country of source has the first right to tax it, and the country of residence can tax it. So it just depends on which country we're looking at, which double tax agreement. But it's always going to be first taxable in South Africa, because the fund has to withdraw the pay as you earn. And then you need to submit your tax return. to declare that income to SARS, and that's where obviously the tax happens. But now you're living in your foreign country, they also want to tax your pension, living annuity. So essentially you're paying double taxation, because if you're in a country where the double tax agreement says that the country of residence has first right to tax your pension, then they have to deduct the tax there. Then you've paid double taxation on that income. And what you then need to do is to request a credit from SARS to get a credit for the tax that you've now already also paid to SARS. You can apply for a tax directive from SARS and that tax directive is then issued to the fund, and it would always be ahead of a tax year starting. So, for example, we would start applying for these tax directives now in November 2023 to apply for it to be approved for the Feb 2025 tax year. So we want it to be approved ahead of 1st of March 2024, so that the fund house then don't need to deduct pay as you earn going forward for the 2025 tax year. To get that tax directive, you first need to prove to SARS that you have submitted and declared that pension income to your foreign country, and you have to prove that you actually paid the tax on that. So in your first year of having this living annuity in South Africa or pension in South Africa, you're going to pay double taxation and claim it back once you've paid tax in the foreign country. And then only the next year, when we were able to prove that you have paid that tax, we can apply for the tax directive. So it becomes quite an admin burden to have a pension or a policy remaining in South Africa because of the tax burden. And this tax directive you need to apply for annually. SARS has recently started to give these tax directives for a 3-year period. So every 3 years you can apply. So it's every 1 to 3 years that you need to apply for that tax directive. So it's quite a bit of an admin burden that someone needs to consider if they are considering leaving their policies in South Africa and not withdrawing it. So that's the tax paying. And then obviously there's the other, the SARB regulations as well, sending the funds abroad. If you have actually ceased tax residency, so you've informed SARS that you're a non-resident, they are allowed to externalize their living annuity and pension payments without needing a tax clearance certificate. But if you haven't formalized this and placed it on record, they would need to apply for a tax clearance certificate every time to send the funds abroad. So again, another admin burden that needs to happen.
And not to mention then the last point there, which is the deterioration of the rand. So essentially, your pension is limited in terms of how much you can withdraw. What you withdraw is then potentially taxed in both countries, depending on where you reside in the double tax agreement with that country. And then sending the money abroad is going to be difficult, depending on what your tax residency status is. And then the value that you receive after tax in hard currencies such as US dollars or Singapore dollars, Aussie dollars, is going to be very minimal. And the amount of work you would have to do during retirement to get this right, filing your tax returns, dealing with the retirement provider in terms of telling them in advance how much income you would like for the year ahead, and then going through the whole kind of South African Reserve Bank foreign currency control regulations to send your money abroad. All of a sudden, this doesn't sound like the ideal vehicle once you leave South Africa. Once you have left South Africa, it comes with all these challenges. Whereas when you are in the country, you are incentivized to build up your capital in the retirement products because of, the tax deductibility of contributions. If you're not paying income tax in South Africa anymore, these become less and less attractive because you're not then getting that tax deduction that you've been so used to getting over the years previous. So now that you live abroad, holding this until age 55 and beginning to draw an income from it becomes a massively tedious task. So I hope that gives you an overview. And if you have any specific questions about this as we go, please put them in the chat, and we can get to them in the next slide. So that brings us along nicely to the next slide about consideration. So if you are a South African pension holder, if you do have any of these products, and you're living overseas, there's a couple questions you should ask yourself in order to determine how best to deal with your pensions and what is the best thing for you to do with them. So the first one is, how old are you? How far away are you from age 55? And how does this affect your retirement products that you hold? Marisca and I have recently helped a client who is age 53. He's 2 years away from retirement. He has a large provident fund from his working time in South Africa. And he was asking us if he should withdraw it now before 55 or wait until after 55. And again, because of his age and because of the type of product, it was important that he got the correct advice, because there were massive implications that would apply to this. So Marisca, do you want to just touch on that, about if you are a older person with a provident fund who is looking to retire in the next 2 or 3 years from now, let's say, and how a provident fund would be treated on that basis, and why they shouldn't withdraw before 55 in that basis.
Yes, okay. So specifically, let's start with the provident fund, is that if you had a vested right at the 1st of March 2021, that means that if you are close to the age of 55 and you can withdraw it in the next 2 years, your provident fund would allow you to withdraw a full cash lump sum of your vested part of your provident fund that you had just 2 years ago. So it would be the majority of your contributions towards that fund that you made up until that stage. So withdrawing at the age of, for example, 53 from a provident fund, you would pay tax at the retirement withdrawal lump sum tables, which is you only get the first 27,500 tax-free, and then the balance is taxed between 18 to 36%. So that's quite a high tax rate that you're going to pay on a provident fund that could be withdrawn at maturity, which would be subject to the lower tax rate, which is the first 550,000 is tax free, and then the balance is taxed between 18 to 36%. So I just want to bring in here Michael's point of that it's not just this first 550,000 Rand. If you had previous pension funds or lump sums that you have withdrawn, it will all be aggregated at this stage. And that's when we then look at that tax-free portion and the tax is calculated. So it might be that you had previous deduction or withdrawals, apologies, and then that would be taxed at a higher rate. So just in summary, for a provident fund, if you are close to the age of retirement, it's best to keep that until the age of 55, where you can actually make use of your full withdrawal on the vested part that you had. And it could be also that if from the 1st of March 2021 up until now, and you reaching 55, the portion that was in your non-vested part could be below 247,500 Rand, which then again you can withdraw the full lump sum on. So for that reason, it's better to hold off and pay at a higher rate. If you were to deduct on immigration, so before the age of 55, then you are going to pay a higher tax rate. And if there's such a small time period left, it's best to just wait for that.
Absolutely. And again, this question of how far are you from retirement and how does this affect your retirement product is extremely important, because if you didn't hold a provident fund, and let's say you held a retirement annuity or a pension fund, it wouldn't make a difference whether you waited to withdraw the full amount before 55 or after 55, because you've immigrated. You would be taxed the same way. That's why, having an understanding of the landscape of how the products work, as well as the tax that applies, is so important. And it can be so confusing because you just thought, well, I have a pension. They're all pensions, aren't they? But they're not. And again, the next kind of question you should ask yourself is, do you intend to retire in South Africa? Are you going to go back and are you going to draw an income from it in South Africa? If you are, you could avoid everything we discussed on the previous slide. And it's not so complicated. It'll be paid into your local bank account. It'll be taxed with all your other income in South Africa. You don't have double tax agreements to worry about. You don't have foreign currency control regulations to worry about. All that sort of thing goes away. But if you do not intend to retire in South Africa, then you default back to what we've just discussed in the previous slide. And it does become quite complicated. Another thing is, if you intend to be offshore outside of South Africa for a short period of time, less than 3 years or 4 years for that instance, and you've crossed the 3-year bracket of immigration, so you've been outside and immigrated for more than 3 years outside of South Africa, should you withdraw your full pension? And again, if you're only intending to be offshore for a short period and then returning back to South Africa, given how tax efficient the contributions to these products are when you are in South Africa and a tax resident there, paying tax there, it probably doesn't make sense for you to withdraw it either. But if you are intending to be offshore for the next 10, 15, 20 years, take up residency in another country and perhaps naturalize, get another passport, maybe you should consider withdrawing it and how best to do that. And that kind of brings us to the next one about contributions. If you're not living in the country, you are adding funds to a highly restrictive product from a product point of view, as well as from an asset allocation and investment point of view, as well as then from, an income withdrawal point of view. There's limits to how much you can withdraw, and then sending it abroad again becomes extremely difficult. So you should then be looking at, okay, if I'm going to be outside of South Africa for a long time, I'm not going to retire in South Africa, or I don't intend to. Perhaps I should look at a substitute pension product that's overseas, that's in hard currency, that's more flexible, that gives you more opportunity to access your capital as and when you need it, in the currency that you need it, unencumbered by products restrictions, unencumbered by, South African tax regime and South African Reserve Bank policy. This is something, you should look into, and something that I help clients do every day. Now, the big question that I'll pass over to Marisca for the last one is, how much tax will you pay if you withdraw your full retirement capital, and what are the alternatives to doing so? Marisca, when you are helping people and guiding them along, this discussion and this decision of should you withdraw everything, is there anything else other than this first initial questions that I've outlined that you would ask clients? And I know I have to unmute you. Here you go.
Thank you. Yes, so I always start with what is the age, because if you are still at the age of 30 or even in your 40s, what is your intention to return? If it's not to return, then leaving your retirement annuity products in South Africa until the age of 55, with the depreciating currency that we have, that could cost way more than the tax that you are going to pay. So I think the first thing that puts people off from withdrawing is, I'm going to lose up to 36% of my retirement funds. And that is true, or it could be true, because how the tax brackets would work is that you will, if you withdraw on immigration, you, as I explained earlier, have the higher tax bracket, where only the first 27,500 is tax-free, and then there's a tier of, depending on whatever the value is, so 18%, 26%, and 36%. It could be 27%. So that would be the brackets that you pay tax at on the withdrawal of that full lump sum. But you then are able to, on your immigration, you're not planning on coming back, no intention of living here or retiring in South Africa, you're able to withdraw your full lump sum, pay the tax of 18 to 36%, and you're able to take your funds offshore where you can invest it in your country of residence and in the currency that is, not depreciating as the years go by. So alternatively, they can leave it until the age of 55 at maturity. And yes, they'll be subject to a lower tax rate because, as I've explained, the first 550,000 of your total lump sums throughout your life that you have drawn is taxed at a lower rate. It does work out less in tax. But if you were 35 and you left your retirement annuity until 55, the loss that you would make on that funds in the depreciating currency would be more than you would be losing in the tax that you are paying. So I think taking the age, what is the plans for the future into consideration, and then looking at the tax versus the currency is definitely a good tool to keep when you are making this decision.
Absolutely. It's a trade-off, and only you as an individual can decide if the trade-off is fair based on your circumstances. All we aim to do is to give you the information that you need to make an informed decision. And to try and also, we don't look at this emotionally, that it's not our lifetime savings, it's yours. Our job is simply to look at this objectively and tell you how to manage it better, and to get a better outcome. So we bring that kind of outsider point of view that could be helpful. So that's really it in terms of pensions, how they work, your access to them, considerations when it comes to should you withdraw them, should you leave them as a South African living abroad. I also wanted to just open this up now if there were any questions to anything specific to South African pensions or taxes or immigration, sending money overseas, estate planning, anything like that. Please feel free to put them in the chat, and Marisca and I can open and give you our 2 cents. So yeah, if anyone has a question, I'll just watch the chat box for a minute. We got a thank you, very insightful. Okay, if there are no other questions, I have one piece that I wanted to touch on that is very important to anyone who's watching who might have children and who has a South African pension. So something that you might not be aware of is estate planning and pensions. So you might be aware that pensions are not dutable for estate duty in South Africa. And you also think that if you have a nominated beneficiary on your pension, that might be enough for your children to receive the assets. Or if that you have a nominated beneficiary and a will in South Africa that says who is to receive your assets. Those are all great things to do. Please make sure you do have nominated beneficiaries on your pension. Please do make sure that you have a will in South Africa governing your assets in South Africa, so that if something happens while you're living abroad, that can be actioned simultaneously to your will in another jurisdiction where you hold other assets, instead of waiting for probate and for the master of the High Court in South Africa, because that will really delay everything. But what's also interesting is that your retirement pension, your pension or your retirement product in South Africa is governed by a board of trustees, and they have a fiduciary duty to you to ensure that these monies go to the people in your family who need it most. So, for example, if you have an ex-spouse nominated as a beneficiary and as a recipient as per your will, and you pass away and you actually didn't want that ex-spouse to receive it because you have children who need it, for example, the trustees of that pension fund, it is their duty to see who is dependent on you financially, who who actually is a true person who needs this money. So please do update your nomination of beneficiaries and your wills to reflect the people that you truly want to receive your money. But if you don't, the trustees of your pension fund will look to track down your dependents and establish dependency. And then what is paid out will be according to the trustee's discretion and not your own. So it's your money, but your wishes may not be recognized. They might be, at the discretion of the trustee. So I just wanted to lay that on there about pensions and estate planning. It is extremely important to have all your documents up to date from an estate planning and succession point of view for your pension, because outside of your house, usually your pension is your largest asset. So yeah, those are my closing thoughts here, guys, on questions and answers. And I see that we've got more thank yous. Thank you, Hillary. Thank you, Kuban. If you at all have any other questions, please feel free to drop me an email or give me a WhatsApp. You guys all have my phone number, and I'll be happy to assist further. For that, when we close out here, here's our contact details. So if you want to talk to Marisca about sending money overseas, the opportunity of potentially selling a property in South Africa, or realizing investments or retirement annuities and the tax consequences of doing so, please contact Marisca at mintaccounting.co.za. And if you're looking to kind of understand your financial planning in Singapore and an overseas context, as a South African abroad, please do get into contact with me to understand, life insurance overseas, pensions, investments, trust planning, estate planning, succession, all these things. We are here to assist and help you to the best of our ability. So, Marisca, do you have any other closing thoughts you'd like to leave our audience with?
Just thank you for joining. It's great that you joined us. And if you have any questions, you can contact me at any time, and we're happy to provide you with tax advice or just assistance. And also if you have any questions about ceasing your residency.
Cool. So everyone, from Marisca and I, and from the South African Chamber of Commerce here in Singapore, thank you very much for joining us. Please stay in touch, follow us on social media, visit our website, and we hope to see you at a future event soon. Good night, everyone.